it's hard
I'm
to
an art
describe.
coordinator.
Like, yeah, it's in a way it's harder than I thought,
Hmm.
but it's not as hard as I thought. It's some of it I'm like, I don't have no idea what I'm doing, and then other parts I'm like, oh, this isn't bad. So then once I get the hang of stuff, it's easy to catch on. It's
Hmm.
just, making sure I get all the information. I think the hardest part is definitely the quizzes. The problems, I can reference the book, kind of look at that, make sure I'm doing it correctly. The quiz, yeah, I can reference stuff, but it's harder to do it in that short amount of time. So I think that's the hardest part. But the rest of it, I mean, I'm doing pretty good. I have most of it down. It's just some of the stuff it's a little hard. I'll admit it.
The quizzes aren't timed.
Right. So basically, like last time, I think I took an hour and 15 minutes on the quiz, and at that point,
Uh-huh.
I was like, okay, come on, Jessica, get it together. Um, so I don't want to take forever on the quizzes, but some of the questions were just a little difficult, and I think maybe I should have. I read the chapter once. I probably should have went over it a couple more times.
Uh-huh.
But yeah, I think that's just the hardest part for me so far.
Okay. Okay. Yeah, the quizzes in, it's some of them are, you know, a little trickier than others. You can see, like,
Yeah.
I've got it. Actually, it helps if I share my screen. Hang on just a minute.
Yeah.
So,
Okay.
hopefully you can see my screen now.
Yeah.
The
Yeah.
quiz. Okay. So, they're multiple choice, right? And
Right.
yes, they're going to be a little trickier than others. I will tell you this. Some of the quiz questions wind up being very similar to what's on the
Mm-hmm.
midterm. So
Okay.
even if you don't do the best on the quiz questions, it's
Mm-hmm.
important that you go back and you review what the correct answers were and try to think, figure out why that answer was correct versus what you put. Okay.
Okay.
So that's a really, really important key to success. It's not only doing that on the quizzes, but also on the homework. And I know that, like in one of my other webinars, I talked about, going back and making sure that you're reviewing your answer key in each module, right? So just
Mm-hmm.
going back in and seeing, okay, now what did I do wrong? What did I do right? Why did I do
Mm-hmm.
something wrong? And so it's all about that analysis that you have to do. And that's one of the reasons why I don't necessarily go through and give you a ton of feedback on your homework, is because I want
Mm-hmm.
you to go in and analyze what you did wrong. And then if you have questions about what you did wrong, come to me, ask me. Why is this right or wrong, or did I, because a lot of times, 9 times out of 10, especially with accounting, you're going to see exactly what you did wrong and be like, oh my gosh, I can't believe, you know, I missed
Right.
that. Or, so if you've read your chapter, if you've gone over the PowerPoint slides with the voiceover, if you've, made a valid attempt at your homework, you're going to most likely do very well, come the midterm.
Mm-hmm.
Okay.
Okay.
So, I know the quizzes can be frustrating because I know some of those are worded, very tricky. And so you have to pay
Yeah.
attention. One of the greatest skills that accounting will teach you is attention to detail. And
Mm-hmm.
I say that because having been in, the accounting and IT world for now and running businesses, you name the business
Mm-hmm.
type, I've probably, done some sort of implementation or running it in some way, shape, or form, producing their financials and everything. I can tell you without a doubt, accounting is more about not so much about math. It's more about rules, processes, and attention to detail. Those are the three keys to accounting. It's all
Mm-hmm.
rules, processes, attention to detail. Because literally all you're doing in accounting is creating basically it's three financial statements, but really, two of them are the main keys that every business runs off of, which is the income statement and the balance sheet. So everything that you do in accounting is going to be in order to create your income statement and your balance sheet. Journal entries are going to typically have, one side of the entry hitting your income statement, the other side of your entry hitting your balance sheet. Some journal entries will be an exception to that rule, to where, you're hitting two accounts on the income statement potentially. That does happen, when you're making some sort of an adjustment, like a reclass or something like that, that can happen. Um, and vice versa. It can also be true for the balance sheet. You could have a journal entry that hits two accounts on the balance sheet, right? But for the most part, you're creating transactions that will hit either the income statement or the balance sheet. Okay.
Okay.
So,
Yeah.
and all journal entries have to equal 0. So it has to
Right.
balance, right? And your balance sheet has to balance. Assets has to equal liabilities plus stockholders' equity at all times. Okay, so whatever your total assets are, if your total liabilities and stockholders' equity are not the same amount, then you've done something wrong. That's a
Right.
way for you to check yourself, right?
Okay.
That is the main concept of accounting. Literally, it all comes down to that. Yes, there are a ton of rules in between that you've got to know and understand, what goes where, why, and basically it teaches you how to manage a business, you know. So that's why it's one of the foundations or the keys to understanding how to run a business. If you understand accounting, then you will understand
Right.
what accounts, are the most important to you, and what accounts are really, not as influential, right?
Mhm.
So, so that's kind of, you know, hopefully somewhat helpful to you in preparing and studying too for the quiz. I know the quizzes are a little different. There were some study guides out there. I've taken them down because they were old study guides that pertained to uh, a previous semester with a previous book version. So the book version is different this semester, and that's one of the reasons why it may seem like those didn't really pertain to the quiz that you were studying for. Okay.
Right. Okay.
So let's go ahead and talk about Module 3. Have you had a chance to dive into that one yet?
I overviewed it a little bit. I usually wait till after like webinars and stuff to really get into it. So
Sure.
yeah, I looked over it, but no, I really haven't started the actual homework or even the practice problems just yet.
Okay. Okay. So had a couple of questions come through email about the homework problems and stuff like that. So you'll see, there's no other webinars out here right now for this. So I'm going to actually spend some time just going through what needs to be done on each one of the problems for the homework in Module 3. That way everybody has a good idea of what you need to do for the homework problems. There's a lot of examples in your book. Let me minimize this one. Go down here. So Module 3 or Chapter 3 in here, or I'm sorry, we're in Chapter 4. Chapter 4, Module 3, sorry, is really about understanding those financial statements. Okay. And accrual basis of accounting, which is what probably I would say at least 95, if not more, percent of the businesses out there perform accrual based accounting. Okay. And accrual based accounting is mainly focused on the revenue recognition and the expense recognition principles, right? So for the most part, what it's saying is that they're going to go in and they're going to do an accrual, which is a journal entry. Okay, so we've already been working on journal entries based on revenue that they are recognizing and expenses that they're recognizing. Okay, so you're going to see all of these concepts basically covered in this chapter. So revenue recognition, expense recognition, allocating prepaid assets to expense, deferred revenue to revenue, accruing expenses and accruing revenue, doing your adjusted trial balance, and preparing financial statements. So, and then it also talks about the closing process,
Mhm.
which is this is literally basically what accountants do throughout the entire close process. Close process is going to be anywhere from a couple of days, depending on how complex the business is and how good of an accounting system, meaning computer system, that you have. Ver, to I've been parts of I've seen them go up to like 10 days from the end of the
Okay.
month. So like the 1st through the 10th. And they typically try to get it down as much as possible to get it
Mhm.
closed and get their financial results out. Okay. And
Okay.
then, an important part is, assessing the accounting numbers, basically the quality of the earnings and, aggressive versus conservative approaches. Typically, every company that I've ever been associated with, we take a very conservative approach because you can get questioned if you're taking aggressive approaches by auditors.
Right.
They don't like that. so,
Right.
um, so there's some really good examples, and it kind of walks you through like the when cash is received. So here's your journal entry, right? And how revenue is earned when cash is received and different things like that. So these examples literally walk you down through all of those journal entries that are making up your income statement and your balance sheet. So you have to understand like revenue is going to hit your income statement. Accounts receivable hits your balance sheet. By this point, it's important for you to understand where these different accounts are hitting. So cash hits your balance sheet. Accounts receivable is balance sheet. That's where, I said there's times when you're going to do an entry that's going to hit, nothing but balance sheet or nothing but income statement. This is one of those instances is when you earn revenue, right? Um, if revenue is earned after cash is received, right? This would be the entry. So, it just depends on how the company is recognizing their revenue. Okay. And the book walks you through this nicely. I was really happy with, the explanation that they put through. Okay.
Uh-huh.
Um, So we're going to kind of just walk down through some of the problems, and you'll see that, the foundation of all of this is those journal entries. So you make the journal entries, and and basically, your unadjusted trial balance kind of shows what some of those are, right? The trial balance
Right.
is just saying, this is what the balance of that account is. These are all accounts. So your GL accounts, your general ledger accounts, right? It's all of these, and that's what the balance is based on whatever entries you've put in the system. Okay? So talks about the different types of adjustments that you could make, etc. And then just, kind of how each one of these um, comes through and affects the other. Okay, so here's accrual adjusting entries. And accrual is just basically like a prediction of, hey, we know we've got this expense coming in. So a good example of this is you can accrue wages, right? You know how much somebody's going to get paid. You know they're going to work 40 hours for you that week, or they're on salary. You know their salary is the same every single month. And so, like, if, for instance, employee, you pay twice a month. First, you pay on the 15th and the last day of the month. Okay. Um, So you know that you're going to have those expenses in that month, right? So if
Mm-hmm.
and you pay in arrears, so they had to have been there. So like the paycheck on the 15th is actually for the period of the 16th through the end of the last month. You know that's going to happen, so you accrue that money at the end of the month, showing that you're going to have, these employees we know worked with us the 16th through the 30th. So when I create that financial statement, I'm going to make a journal entry accrual for all of my wages that um, happened on the 16th through the 30th, 31st, whatever the case may be, or 28th if it's February, right?
Mm-hmm.
So I'm going to accrue those wages at the end of the month onto my financial statement so that my financial statement accurately reflects how many people worked with me, what my wages were, etc. That's accrual based accounting. You're just doing a journal entry at the end of the month for
Okay.
expenses or for revenue that you earned or incurred in that month.
Mm-hmm.
Okay? That's all this is. That's all an accrual means. Okay?
Yeah.
Um, Same thing goes, and you can do it for literally anything, right? Like you got hit with interest in the month. So how much interest did you get hit with? Okay. So you got an interest expense and an interest payable, right? And then when in the next month when you actually pay it, you're going to, basically work it out of the payable and show it to cash. Okay? So it
Mm-hmm.
comes out of your cash and, debits your payable to decrease it. Okay? Um, So yeah, this works down through a lot of those adjustments really nicely. And then it
Mm-hmm.
shows you how to prepare an adjusted trial balance. So it's basically showing, all that is what the balance was at the end of the previous month, right? Plus
Mm-hmm.
any of your debits and your credits, right? So these are the adjustments in the current month, right? And then all you have to do is take that and either add it or subtract it, whichever the case may be, right? So if it's a debit, you're going to add it here. If it's a credit, obviously you're going to subtract it here,
Mm-hmm.
right? So this is a good example of what that needs to look like. So, this Exhibit 3-4 on page 133 is a good example of your adjusted trial balance, how that works out. So pay attention to these because again, you're gonna want to make sure that you have both your debit and your credit column in each one for the ending balance from the previous month, your adjustments in current month, and then that gives you your adjusted trial balance. Okay?
Mm-hmm.
So just pay attention to how those kind of work through. Okay? Um, So preparing income statements, balance sheets, this is down here on page 135. This is a good example of, how your adjusted trial balance, all of that stuff that we did previously, is going to be affected, on your financial statements. So here's your balance sheet. And this is where it becomes very, very important to understand cash goes on a balance sheet under assets. Accounts receivable is
Mm-hmm.
also an asset. So you can see like this portion of the adjusted trial balance comes up here under assets. This portion where you started accounts payable comes into liabilities and stockholders' equity. Okay, all the way down through the common stock, right? Retained earnings, okay, is part of your statement of stockholders' equity. Okay. Um, the common stock also helps in calculating your stockholders' equity, right? So this chart right here basically shows you how that adjusted trial balance helps you to create your balance sheet, your statement of stockholders' equity, and your income statement. Because here's all of the expenses that go down here. Here's your fee revenue, which comes in right here. Here's your net income, which also comes in right here in your retained earnings. Okay? Making sense so far?
Yep.
So this is a good graph for you to reference. This is something I would bookmark in my book and make sure I had it available for every quiz or test that I took. Okay?
Right. Yeah.
that's one it will be tremendously helpful to you. Okay?
Right.
Then, you can come in here and see, it says your turn, so it asks you to do the adjusted trial balance, right?
Mm-hmm.
Then we get into the closing process and procedures. And so basically at this point, it's like close the revenue accounts, close the expense accounts, just the closing procedures. That's something that you're going to want to kind of look at too, and take a look at the fee revenue, the retained earnings, and basically all this is a journal entry that kind of walks you through how to close the GL, right? So, and this shows you the T accounts. We've been working a lot with the T accounts. This shows you the T accounts, how to process that out. Okay. Post-closing trial balance is shown here in 3.7. Okay. So it basically just says, hey, for the trial balance as of December 31st, this is what it should look like. And you'll notice that your debits and your credits equal, right?
Right.
That's always the case. That's always the truth. The summary of the accounting cycle is right here. I would know that, just maybe reference that. It's a good quick reference for you to check in case there's a quiz question about it. Okay.
Right.
Um, and then, quality of the earnings numbers and different things like that is also a discussion because obviously, there's a reason why we have GAAP and SOX compliance in accounting now. People like
Mm-hmm.
Enron, back in the day, which was a while back, I know. But if you ever want to figure out why we have all of these rules and regulations in accounting, go look up
Mm-hmm.
Enron.
I will.
it's it's quite an interesting, and they weren't the only ones. Don't get me wrong.
Mm-hmm.
There's a lot of places that have gone out of business. There was a major accounting firm that went out of business because of their roles in basically what we call cooking the books. So, how we talked about that accrual based accounting? Well, they were making
Mm-hmm.
some pretty fantastic accruals that never came
Oh.
true. Okay. So, that's why we have so many auditors in place, and that's why auditors, because honestly, back in when I first started my career out of college in 2000, we didn't really have that many auditors coming in and auditing our books. It was more of you had an accountant to do your tax accounting for you, but there wasn't really a heavy focus on audit, right? And at least not with smaller companies. With the bigger companies, yes. Public companies, yes. The SEC's been in place for a long time.
Mm-hmm.
But the many times we don't encounter rules and have to start working with strict rules and procedures and processes and audits and different things like that until somebody does something really wrong to basically hose a bunch of other people. You know, that's why this all came in play because, companies like Enron and even WorldCom, I don't know, you probably never heard of them, but they used to be a major telephone giant, um, that competed with AT&T, right? There were a lot of them that were cooking their books and
Mm-hmm.
making some pretty fantastically false entries and providing very false financial statements um, and management commentary to their shareholders. And some
Mm-hmm.
of them wound up going belly up because it literally, the stuff that they were saying just wasn't true. And their financial picture was much more bleak than what they were painting, so they went under and their shareholders lost a lot of money. And when that happened,
Mm-hmm.
there was huge reform and regulation and everything else that was put into place. GAAP, generally accepted accounting principles, number one, and SOX compliance, which is Sarbanes-Oxley. Um, we call it SOX, SOX. And that is when a lot of the auditing came into place, whether you were public or private companies, because
Mm-hmm.
there's just a lot more regulation on what you're allowed to do. Like even the IRS got in on the action because obviously they were getting taken for a ride too, because companies will do whatever they possibly can to avoid paying taxes. Everybody will. None of us like to pay taxes. So if you show
Right.
a loss, from a tax perspective, because you can have multiple sets of books. So from a tax accounting perspective, you show a big loss, you don't have to pay taxes.
Right.
But at the same time, if you're showing a huge profit to your shareholders, it's like, wait a minute, which version is true, right?
Mm-hmm.
So, that's what, and it's still to this day, it's, I've seen some companies that have put in some pretty questionable entries, right? So that's why a lot of this stuff has come into play with accounting, and that's why you start talking about quality of results. Who just joined?
Mm-hmm.
Hello?
Amanda.
Hey Amanda, how are you?
I'm good.
Good. We're just going down a quick review of chapter 3, and I'm about to go into the problems, so you're just in time. Okay? I told Jessica, the book, the version changed, and so I've had to take down all of the previous stuff that I had because it wasn't making any sense with what you guys have this semester in this book. So I didn't want anybody getting confused on the problems or the concepts or anything. Concepts in general are the same, but the study guides and everything else were not the same, for the quiz and other such things. So I took those down, and I'm just going to do new webinars for you guys this semester to kind of go through with you, um, what the content is today. Okay, so so let's hop over into our problems. We're going to go down to exercise 4-1B, which is your first homework problem. Am I still in 3? Yeah, I am. There we go. So for this particular period, we're working with your balance sheet classification and analysis. So this really goes down through like what are the different financial statements, right? So it tells you everything you need to know about balance sheets. So you got your current assets, long-term assets, current liabilities, long-term liabilities, stockholders' equity, right? So those are your main categories in your balance sheet. Now you need to know what is under each one of those. Okay, so that's where, I had been harping on and kind of saying, look, you guys need to know what goes under each one of these different sections on your financial statements, right? So this is kind of going to help you to understand those breakouts, those sections. So it's literally just organized like you would, titles, subtitles, stuff like that. That's all it is. And if you look at these enough, you'll see everything's going to have current assets, then non-current assets, or long-term assets, whatever they want to call it, right? Current liabilities and long-term liabilities, then stockholders' equity, which is your capital and your retained earnings. So the definition of current, and this is very easy to remember, current is anything within the next 12 months. Okay, so anything that will be turned into an asset within the next 12 months. Okay, non-current is stuff that is considered going to be on your balance sheet for longer than 12 months. Okay, so for instance, with assets, it'd be something like property, plant, and equipment. You don't necessarily plan to purchase property, plant, and equipment as an asset if you're not going to keep it for more than 12 months. Okay, typically companies purchase for more than 12 months on that end. Intangibles are stuff like trademarks, copyrights. Those are intangible assets, right? You can put a value to them because it is part of your value, right? And then you have other long-term assets as well. Okay. So you could have you could have a section for non-current assets, right? Then liabilities, same thing. It's anything that's going to require payment within a year. Okay, so current is always going to be within 1 year. Okay, long term is everything that's over a year. So like if you owe somebody money on a long-term liability, that's over a year. So a bank note that's like 72 months or something like that, you could consider that long term. When it comes into being due, or you will finish it out within the next 12 months, then it's a current liability. Okay, so then it becomes a short-term note payable, right? So just keep in mind that time frame. It's always within a year. Okay. Income statement as well is going to be pretty straightforward. It's going to show you the different sections of the income statement. Here's a great balance sheet right here for you to reference on page 194. Okay. On the income statement itself, you've got a start of one, pretty short one, but it still shows you your revenue, your expenses, things like that, all broken out here. And then you get a multi-step income statement. So this is like for a service firm. This is just noting that a service firm isn't going to have cost of goods sold. So one of the things that you have to understand about an income statement or a balance sheet is it really depends on the type of business that you're running. So for instance, a software company, it has products and, it does have products that they sell, but a lot of times in a software company, which I deal a lot with, they will also have services, professional services. So who installs it? who provides help desk support. So you have professional services that is also a product. A lot of times, they're not going to have a cost of goods sold, right? They're going to have, and they won't necessarily have a gross profit on sales. So that's just something to note, is there will be times when you have a particular type of company, like an advertising firm or something like that, that they don't necessarily have cost of goods sold, right? So they're going to have more, you're going to see that more where you actually have a product to produce to people, right? So that's where you're going to see that cost of goods sold. Okay. Other things that this chapter covers is also analysis based on ratios. So here's all of your ratios. And you'll want to take a look at each one of these. They're very, very easy ratios to do. Make sure, let's see, I think there's probably a quick cheat sheet. Where's it at? On the ratios, and if not, I will find you one. There used to be one in the other book, so I can't imagine they took that away. Okay. All right, so I'll find you a quick cheat sheet of the key ratios. Oh, here you go. Here's some of them. And I'll find you another one that has all of the key ratios on it, and I'll post it. Okay. All right, so going down to our exercise set 4-1B. Okay, so this is preparing a classified balance sheet. So basically it's asking you to literally just prepare a balance sheet based on these entries. So as of December 31st, all accounts have normal balances. So basically what it's having you do is literally take this and create a balance sheet like the one that you saw before. So where would accounts payable go? I'm going to ask you guys. What section does that go under? Think about the wording. What's a payable? An asset.
Liability.
It's a liability. So is that a current liability or is it a long-term?
Current.
Current. Good. What about accounts receivable?
Assets.
Current or long-term?
Current.
Very good. Building and equipment?
Long-term assets.
Good job. Cash?
Current assets.
Awesome. Common stock?
Liabilities.
Not quite.
So shareholders' equity.
Yep. Stockholders' equity. Good job. Inventory. Where would you expect that one to be?
Assets.
Exactly. Is it long-term or current?
Current.
Current. Good job. Land?
Would be the same as equipment, right?
Yes,
So
exactly.
long-term assets.
Yes, exactly. Mortgage payable, long-term. So it gives you that part.
So would that be long-term liabilities?
It would be. Yes. Excellent. Office supplies? What do you think?
Um,
Think about how fast you run through office supplies and what that would be. You own it, right?
so would it be an asset?
Yes, it would be. Is
And
it
it would
a
be current, right? Because it's
exactly? Yeah. You would never consider office supplies long term because typically it's expected or implied that you run through office supplies within a year, right? So,
so like office supplies would be like papers, pens, things like that.
yeah,
But anything like copy machines and stuff like that, that would be considered like equipment.
yes, exactly.
Okay.
So, and depending, that's a fantastic point too, by the way. Things like copiers, typically companies lease those. So that could be actually a long-term liability because depending on how long the lease is, if it's like a 60-month lease and you're only, 5 months into it, you've still got well more than a year to pay on that. So that could be considered a long-term liability versus an asset.
Okay.
It just depends on, what you're doing now. If you purchased that copier, right, then that's an asset. But anytime that you have a note or a lease or anything payable, it's going to go under the liabilities. Does that make sense?
Yeah.
Okay. Retained earnings.
Would be stockholders' equity.
Exactly. Now, you'll notice that that one has a question mark on it. You have to figure out what retained earnings would be. Okay? How are you going to do that? You got to work your way backwards into this one. Okay? So for retained earnings, remember, a balance sheet is always, always, always going to what?
Balance.
Balance. Exactly. So your total assets has to equal your total liabilities plus stockholders' equity. You've been given every other number except retained earnings. So what you have to do is you have to figure out what are my total assets, what's the total of that, and then what are my total liabilities, right? And
Hmm.
figure out how much you're missing from the total liabilities. That's going to give you your retained earnings number, and it should equal the total assets. So total liabilities and stockholders' equity has to equal total assets. So whatever you're missing from that number is going to be your retained earnings. Does that make sense?
Yes.
Okay. So that's how you have to work your way backwards into that number. So salaries payable, where's that going to go?
Liabilities.
Mm-hmm. Current or long term?
Hmm.
Think about, you think people are going to work for you if it's long term?
Yeah. No, so it'd be
People
current.
typically want their money. I
Right.
know I do. So, so yeah, it's going to be current liability. Okay?
Okay.
So that's how you work down through that problem, and you're literally just creating a balance sheet. That's it. Okay? And organize it like a balance sheet. You're going to put current assets, non-current assets, total assets, current liabilities, non-current or long-term liabilities, stockholder or total liabilities, stockholders' equity, total stockholders' equity, and then total liabilities and stockholders' equity. Those sections just like you would in a balance sheet. Okay? And
Hmm.
list out all of these different accounts with them. Okay?
Hmm.
All right. All right. So then next problem is 4-2B, this one, creating that multi-step income statement. Okay, so you're doing literally the same thing. All right. And you're going to go through and prepare the income statement. So first things first, what's the first account that you're going to see on an income statement? Think about the order. You're always going to have revenue, cost of goods sold, and then that gives you your gross profit because you're going to basically subtract those two out. Okay, so you've got those two numbers here. You've got your revenue and you've got your cost of goods sold. That's going to give you your gross profit when you subtract those two out. From there, you're going to then take selling and general administrative expenses. Okay, so you've got that number. And that's going to give you your income from operations when you subtract this number out from your gross profit. Okay. Then you've got other income and expenses. So one of the things that they give you is this interest expense. That's one expense, right? So that's going to give you your income before income tax when you subtract that out of the income from operations. Okay. And then you're going to get your income tax expense of $8,000, and that's going to give you your net income. So that's how you get down to the net income. It may not seem like they gave you a whole lot of numbers to get your income statement, but they really did. They gave you everything you needed. You just have to put it in order and subtract it out. Okay. So definitely reference, let's see. Let's go back up here. This right here. Okay. You can reference that one. You can reference this one. This is the one that you really should reference right here. 4-4 on page 196. This is going to give you that exact setup that I just talked about. You don't have any research and development expenses that it lists out, but you do have the selling, general, and administrative expense. Okay, that's going to give you your income from operations. Then you've got the other income and expense. Then you've got your income. You know, this is the breakout that we're looking for right here. Okay, make sense?
Yeah.
Okay. Then we're going to go to problem dash 4-10A. This is a journal entry. Okay, so let me get down here to 4-10A. All right. So this is just a journal entry. Okay, and so all it's asking you to do is to come in and do the journal entries for the balances, the general ledger, as of December 31st. So the first one that you're going to do is insurance and the insurance expense to the prepaid insurance. Okay, and you have to come in based on this, right? So you did prepaid insurance, December 31st was $1,500. Okay, so to record the insurance, the expired insurance, you have to come up here and find, here's my prepaid insurance right here. It was sitting at $3,000. So you're going to subtract that $1,500 from that $3,000 to get your debit and your credit for insurance expense and prepaid insurance. Okay? So basically all this is asking you to do is to come down through and do insurance, the insurance, then the depreciation expense on furniture and fixtures, the depreciation expense on delivery equipment, which again, you come in here and you figure out which one of these is applicable, right? And do you have to subtract anything, or is it just literally recording what is down here? Okay, so in some cases, you will have to subtract, like in the first one. In this case, you're just recording a new depreciation expense, right? So the 2,000 and the 11,000. You're not actually subtracting anything up here, okay? Then you have to do your sales or your salaries, salaries payable. So it shows you 1,800 for sales, you'll record that one. The 1,200 for office, you'll record that. And then your salaries payable, that is going to be your total of those two. Okay. So you have your two expenses, your salaries expense for sales, your salaries expense for office, and your salaries payable will be your balance sheet. Okay. Then we come down, and the last one we do is unused office supplies. So you have to go in and basically take a look at what your balance was in this one, which is right here. Okay, $4,200. And your unused office supplies were $1,200. Okay. And so you're going to take that $4,200 minus that $1,200 to get the office supplies expense and the office supplies balance that would be listed on your balance sheet. Okay, so that's the journal entry side of what you're looking to do. Then they want you to come in and prepare a multi-step income statement, same 4-4 reference that we had before, using the numbers that are up here. So your sales revenue, your cost of goods, right? And that's going to give you your gross profit. Then your selling general administrative expense, you actually have to add that together for all of the different numbers that they've included in here. Okay, so that's going to include anything that has the word expense behind it. Okay, so if you see all of these, you're going to have the 4,800, it's these numbers right here, down to the 56. I'm sorry, it's also highlighting over here. That's my bad. So you're going to have your utilities expense, sales salary expense, delivery expense, advertising expense, rent expense, and office salaries expense. Then you're also going to have all of the journal entries that you just created. So all of everything here. So the 1,500 here, the 2,000 here, the 11,000 here, and the 3,000. This was not an expense. This was a balance sheet entry, so you don't include, or I'm sorry, yes, you do include this one. Sorry, this was an expense. So all of these down here also have to be included in that calculation to get your selling, general, and administrative expenses. Okay. Then that'll give you your income before tax. Then you also have your income tax expense. So you'll take that out, and then that gives you your net income. Okay? Questions?
No.
No.
All right. Then the final one is an extremely long journal entry. So solution to 5-2A. So this is where we go into chapter 5. Okay. Chapter 5 is basically the nature of merchandising operations, right? So if we go into this, it's talking about merchandising operations. So this is like a retail store, okay? So they use Target as one, right? So it's basically understanding that operating cycle and kind of how to manage this type of business. Remember, every business has a type. You're either talking about retail, you could be talking about software, technology. Technology is a very wide range. It could be technology, like medical technology is one. When you say the word technology, that can mean a multitude of types of business, and they all operate differently, right? You could have pharmaceuticals, you could have healthcare, you could have, manufacturing, distribution companies. These are all different types of companies, and they all do business just a little bit differently and have different components. So that's kind of what the book's trying to prepare you for, is the fact that you need to understand some things are tracked differently and there's different rules for everything. A merchandising company works a lot with inventory. So inventory is very important to a merchandising company. The same thing is true for a distribution company and a manufacturing company. Both of those types will be heavy, heavy inventory type companies. Okay. So basically, this chapter is focusing on how to analyze and how to account for these types of transactions. Okay. So the problem, basically, after you go through and, read this chapter, make sure that you understand how manufacturers convert raw materials. A great example, and it talks about component parts into finished goods, finished products. Okay. So let me just kind of share with you a little bit of some of my implementations that I'm going through right now, because I'm actually setting up the ERP systems for multiple types of businesses right now. So I understand very well why there are such differences, right? So one of my clients, current clients, is a manufacturing company. They manufacture baths, showers and bathtubs. Okay. They have different molds that make these showers and baths. So they actually make the units that get installed into houses and apartments and hotels and this, that, and the other, right? There are all different components that go into making one of those tubs or shower units, and they can have all different configurations. So they have to keep inventory based on what they believe to be coming down the pipeline. Okay. So it's very important that they know what opportunities they have, what sales that are closing, within the next week, within the next month, even within the next quarter, because there could be a lead time on some of the parts that they need in order to manufacture those units. And every unit is different because you never know. It's a highly customized business. So you never know what your customer is going to wind up ordering. Okay. So they could have, let's say they're doing a major hotel. Okay. Hotel has 300 rooms. Okay. Each of those rooms is going to have its own shower tub unit. Okay. And each of those shower tub units can have a different configuration. Like the drain could be on one end, or it could be in the middle, or it could be on the other end. They may need the extra handlebars, right? The handicap bars, where you can grab onto something. That could be on the left side, it can be on the right side, it could be in the front, it can be in the back, right? So there's just different configurations. So each one of their finished goods is going to have what's talking about different component parts. Some may have one sub dish, some may have two, some may have, the indentation that holds all of your stuff, others may not, right? So there's a lot of, they convert all of these raw materials, and it could be things like the resin, right, that they use to finish the shower. It can be the finish, like they have a plain white one, and then they have all of these color options that include like a granite-like finish. And they literally, I was told the other day, if you want a unicorn painted on your shower, we can do it. So I was like, wow, that's a bit of a stretch, but okay. So they literally can do virtually everything, but that means that there can be a different configuration for every one of their showers, right? So all of that's what they mean by taking a raw material. So you've got your material that it takes, like the finish, the material that they're using to finish the shower, the component parts like the grab bars and the soap dishes and things like that, to make that one finished product. Okay, so that's what a manufacturer goes through, and they have to keep track of all of that. They have to keep track of their inventory, in order to, like in here, it's talking about Ford Motor Company. Think of all the parts that go into a car. They got to have them in stock, right? So they have a lot to deal with, right? Wholesalers, you know, you might have a wholesaler like Cisco's a good example, the computer chips, right? Those could go to virtually anybody. They could go to Dell, they could go to Ford, it just depends on the product, right? So wholesalers, even pharmaceuticals, like I have a pharmaceutical client as well, pharmaceutical distribution client. They are basically a wholesaler to the small mom and pop pharmacies all over the country. Okay. So that's what they do, right? So that's a different type of business. They still have to have inventory, and they get their products directly from the drug manufacturers, right? So, and then they can sell, kind of in larger quantities, or in smaller quantities, I should say, to the mom and pops that don't want to keep huge amounts of inventory, okay, of these really expensive drugs, right? So that's another client. Right. So there's just all these different types of businesses. And that's kind of what the book is trying to demonstrate to you is how these different merchandising cycles happen. Okay. So when we get down to problem 5-2A, let's go down here. And it's going to run you through stuff like, your cost flows and your systems, inventory systems and stuff. Pay attention to that because it's extremely important stuff for you to understand. And if you have any questions on it, please ask. Okay. So 5-2A, this is basically taking you through the journal entries for merchandise transactions of a perpetual system. Okay. So understanding the perpetual side of the journal entry. Okay. So basically it's going to give you the list of, events that occurred. Okay. So this is their perpetual inventory system. Okay. So if they purchased merchandise from Norris for $4,000 on terms, obviously. So terms means 2, 10, net 30. Okay. So if they paid within 10 days, okay, they would get a 2% discount. Okay. If not, it was due within 30 days. That's what this terms 210 net 30 means. Some companies will do this. Other companies will not. Okay. A lot of them are going away from it because, believe it or not, if you offer a company terms like 210 net 30, they're automatically going to take the 2% discount whether or not they pay it in 10 or not. And it's very hard to collect on something that they didn't meet because they will argue with you about it, number one. And if they're a good customer, you're going to give it to them because you don't want to lose the business. There's a lot of competition out there and people will drop you in a heartbeat. Okay, so we've seen a huge downturn on companies using this 210 net 30. Most of the time, it's either net 10, net 30. You're not going to get a discount. That we don't offer that. Your terms are you either, like my company expects you to pay your invoices within 10 days. So our terms are net 10, and that's in our contract. Many companies I know and work with are using net 30, and it's straight net 30. They might extend greater terms to government contracts. So, like the government, I think, automatically states that we'll pay you net 60, and you're going to do it because we're so huge. They can dictate that. They can say we're only paying you in 30 days. That's it, or in 60 days, and most places will go along with that because it's a huge, huge, huge organization and very stable. So, you go down through basically, and you're going to be doing, like for this one, it would be, you're going to hit your inventory account and your accounts payable, right? Because again, this is on terms, so it's on accounts payable, not on cash. Okay. If it says something like paid freight, obviously, if you pay something, it's coming out of your cash. So on here, you're going to hit your inventory again, because freight is always part of your inventory calculation. So you're going to hit your inventory and cash. Okay. Then the next one, sold merchandise to Denton for $5,500 at $4,100 cost. So this is 2 entries, guys. This one, you're going to show your revenue or your sales and your accounts receivable. Okay. For this one, you're going to show your cost of goods and your inventory. Make sense?
Mm-hmm.
Okay. So basically what you're doing, it seems like there's not that many, but there are actually a lot of entries with this, because just like this one, you could have multiple steps that are included in that. Okay. So you have to go down through and figure out what are those steps that have to be taken for each one. Okay. Make sense?
Yeah.
All right. So that is Module 3. What questions do you have? Do you want to talk about anything else? Any questions about quiz prep or anything like that?
No, I'm good.
No, I can't think of anything.
All righty. Well, I appreciate you ladies joining me tonight. Let me
Yes,
know.
thank you.
Let me know if you have any questions. And, for the rest of the class too, I did record the session, so I'll post it up there as soon as it's converted. And you should see it in the module here soon. I'll post an announcement about it. And then, just let me know if anything else comes up.
Hey, thank you.
Okay.
No problem. All right. Talk to you guys later. Talk to you next week for sure.
Okay.
All right. Thanks, everyone. Bye-bye.
Bye.